Happy Friday, everyone. Thanks for joining us today on this edition of Business Daily. I'm Lee Ji-yoon in Seoul. Let's get started with a look at today's highlights. There are mounting concerns about prolonged weak growth as Korea's economy expands under the 1% mark for the fourth consecutive quarter. OPEC has reached a deal to slash production, sending oil prices soaring since the meeting. We take a look at what impact this landmark deal will entail. These stories and more coming right up. Korea is looking at mounting challenges in its economy as its GDP grew just 0.6% in the third quarter, downward adjusted from the central bank's preliminary data. Our Shin Se-min starts us off.
It appears to be locked in a slow growth rut. Korea's GDP grew 0.6% in the third quarter compared to the three previous months, down 0.1 percentage point from the central bank's previous estimate. That puts the Korean economy in the 0% growth range for a full year. It's a slowdown from the 0.8% growth seen in the second quarter and lower than the 1.2% logged the same period last year.
Third quarter growth was mainly driven by consumer spending and government expenditures, which contributed 1.4 and 0.2 percentage points to the total growth, respectively.
The manufacturing sector shrunk nearly 1% in the three-month period from the second quarter. This as two of Korea's biggest firms, Hyundai Motor and Samsung Electronics, suffered from unexpected setbacks. The automakers' union went on a protracted general strike, while Samsung was rattled by the global recall of its ill-fated Galaxy Note 7 smartphone. Construction saw a bit of a slowdown, growing 3.7%, while the country's exports inched up 0.6%, down from the preliminary 0.8%. What's more is that Korea's gross national income fell for the second straight quarter, edging down 0.4%, logging the first consecutive quarterly fall since the 2008 global financial crisis. And this trend may be just the beginning.
At least up until the first quarter this year, low global oil prices had benefited trade conditions, in effect improving real purchasing power. That's why the GNI has stayed on a positive trend until the first half of the year. But with the cheap oil effect now gone, consumption will see a slowdown as well.
In other words, the economic outlook for the remainder of the year as well as the next look dismal. Despite the BOK's confidence that Korea will reach its annual growth target of 2.7%, the greater concern is what's to come in 2017, with uncertainties looming over the incoming U.S. administration as well as Korea's domestic political turmoil. Shin Se-min, Business Daily.
Today is the deadline for the National Assembly to pass the country's $343 billion budget for next year, and lawmakers have talked over their differences to finally reach an agreement on the budget plan this afternoon. Lawmakers will vote on the bill during today's full session, enabling them to potentially meet the deadline, which is 30 days before the start of the new year. The government and political parties have been at odds over a free childcare program for children between ages of 3 to 5, but today the government agreed to pay some $730 million toward a $1.7 billion childcare program. It has also agreed to raise income taxes for people earning more than $426,000 a year and impose a 40% income tax rate. Meanwhile, the opposition bloc's demand to raise corporate tax rates has been turned down. And moving on to markets, to give us a wrap-up of this week's stock market action, we have our Business Daily's markets contributor, Choi Jin-seok, joining us on the phone today. Hello, Jin-seok.
Thanks for having me.
All right, so as we wrap up the week, how are things looking on the trading front?
The Korean equity market closed with a downtick on the last session of the week. The Kospi fell by 0.6% to close at 1970.61, while the Kosdaq followed with a 1.2% drop. Both foreigners and institutions sold shares on the Kospi market for two consecutive sessions. By sector, technology and semiconductor companies saw a decline in share prices as the tech sector in the U.S. overnight showed weak performance. The tech-heavy Nasdaq index plummeted by 1.3%, with the Philadelphia Semiconductor Index sinking by almost 5%.
And today's drop definitely hurt overall sentiment here in the Korean market. So how is the overall weekly performance?
Right. On a weekly basis, the Kospi fell slightly, while the Kosdaq dropped by around 2% after last week's 3.6% plummet. Through Thursday, the Kospi had enjoyed a 0.5% rise, but today's drop reversed the overall trend on the market. Despite foreign investors' massive stock buying thanks to many positive factors, including robust U.S. stock markets and the OPEC agreement on production cuts, Samsung Electronics' dividend announcement, and better economic data from China, retail investors and institutions who unloaded shares dragged down both indexes.
Starting next week, we'll have a number of central bank meetings that will draw a lot of attention from investors. So with that, what market events are lined up for next week?
Right. We start off with the ECB next week, Thursday, and then in the following week, we have the U.S. Federal Reserve on the 13th and 14th, along with the Bank of England on the 15th. After that, the Bank of Japan will hold its monetary policy meeting on December 20th. These meetings will give hints on future directions of global monetary policies in 2017. In other words, we can expect a somewhat wait-and-see mode throughout next week. This has been News Up for Business Daily.
It appears that Samsung Electronics is pulling ahead of its Japanese competitor Toshiba in the NAND flash semiconductor market. According to industry tracker DRAM Exchange, Samsung retained its #1 position in the quarterly revenue ranking thanks to strong demand from Chinese smartphone makers. The Korean tech giant saw its third quarter shipments jump 20% compared to the previous quarter. It recorded $3.7 billion in sales, bumping up its share of the global market to 36%. Toshiba's sales were under $2 billion, with market share falling below 20%. Online shopping has posted a fresh record high in October. According to Statistics Korea, total online shopping transactions reached $4.8 billion in October, up roughly 17% compared to the same time last year. About 56% of all purchases were made on mobile devices like smartphones and tablets. The statistics agency says this overall increase is largely due to the Korea Sale Festa that continued throughout the month of October. Demand for cosmetics surged the most thanks to Chinese shoppers, followed by winter clothes. The government has been putting in a lot of effort toward boosting sagging consumption here in the country. But growing economic uncertainties are even discouraging active consumers from spending more. Our Lee Ju-young has this report.
Even in the midst of slowing economic conditions, active seniors as well as single-person households had been the beacon of light firing up Korea's consumption. But third quarter data released by Statistics Korea shows that they are starting to tighten their purse strings. While other age groups somewhat increased their spending compared to the same time last year, those aged 60 and above cut back on expenses by over 4%. This reduced spending has been a continual trend from the beginning of the year, a drastic difference from just 1 year ago. The tendency to shell out less is also visible among Koreans that live alone. Despite events like summer vacations and the Thanksgiving Chuseok holiday, spending only grew by 1.4% on year. This is a significant drop from the previous 3 months. Their propensity to spend also reached 75%, the lowest level since data was run in 2006. Experts say on top of income growth remaining stagnant for years, gloomy growth projections under the 3% mark for Asia's fourth largest economy are prompting past avid spenders to save up and prepare for uncertainties ahead. Lee Ju-young, Business Daily.
It's now time for a closer look at some important global business stories from the week. And for that, we're now joined by Eunice Kim in the studio. Hello, Eunice.
Hello.
All right, so it was an impressive turn of events. I mean, defying many skeptics, OPEC nations drew up a last-minute agreement on production cut, slashing oil production by 1 million barrels per day, right?
More than 1 million,
Oh,
yeah.
wow, more than. Okay, and now we're learning that Russia might have actually played a critical part in all this.
You're absolutely right. And this is the first time in 15 years that Russia will have taken part in a OPEC production cut. As you know, the Middle East is a region of deep ideological divides, notwithstanding the rivalry between Saudi Arabia and Iran. But the cost of not acting was simply too much, as plenty of oil-producing countries, including Russia, had been squeezed under years of growing budget deficits and debt. Take a look. It took a 2 a.m. call from Russia to Saudi Arabia's oil minister to keep the hope alive, according to reporting by Bloomberg. Hours before the November 30th meeting among OPEC members, Russian Energy Minister Alexander Novak promised Moscow would not only freeze its oil production, but cut it by 300,000 barrels a day if Saudi Energy Minister Khalid al-Falih could get an agreement out of the Vienna meeting. The push came after months of official and unofficial meetings, from the G20 summit to Algiers, and diplomacy over WhatsApp. And it was the push that Riyadh needed to bite the bullet and make the difficult concessions required to get all OPEC member countries on one page. The surprise agreement called for a cut of 1.2 million barrels a day by 13 OPEC nations, effective in January for 6 months, with an option to extend the pact for the rest of the year. Saudi Arabia will take on nearly 42% of the cartel's reduction. Number 2 producer Iraq, which had fought to stay out of the cuts as it was warring with the Islamic State group, conceded, while Iran, despite fighting a proxy war with Riyadh, won a reprieve by agreeing to keep its output below 3.8 million barrels per day. Kuwait, Qatar, the UAE will cut a combined 300,000 barrels per day, and along with anticipated reductions from non-OPEC nations, the reductions stand to erase about 2% of current global production. While it remains to be seen how long it will take to get the global oil supply and demand to rebalance again, the International Energy Agency says this week it expects the OPEC deal to certainly help, and that the rebalance could come before the end of 2017.
So reducing the oil glut is definitely a priority here, but rebalancing will depend a lot on other outside factors, right? So what does OPEC forecast the effect will be on oil prices?
Well, OPEC economies are aiming for the $55 to $60 per barrel range, and that'll help oil-dependent countries like Venezuela, Nigeria, Brazil, and Russia pull themselves out of deficit spending and, in some cases, recessions. Venezuela's oil minister told Bloomberg yesterday that he could see oil going as far up as $70 a barrel if inventories go back to normal. Now, here's what Brent crude was trading at as of lunchtime today, a bit of a dip, but still above $50 a barrel at $53.59. This says investors are coming to terms with the possible challenges in implementation. OPEC countries' October production was aggressive ahead of the November meeting, and for one, the new quotas will largely run on an honor system, with monitoring limited to monitoring that of outbound oil tankers. Now, it'll be difficult to monitor Russia's output since most of its exports actually move by pipeline. So if countries get greedy, which they have in the past, they could exceed their quotas, which would then defeat the whole purpose of this production cut deal. Now, the agreement is contingent on non-OPEC countries as well. OPEC and non-OPEC nations are set to meet next Friday for further discussion. sanctions. And as I mentioned in the report, this pact is good for 6 months. They'll need to keep the momentum going for prices to stay above $40, $50 levels. And finally, U.S. shale producers. Now, if prices reach $60 and above, many are saying this could incentivize U.S. shale producers to start pumping again, though this will take some time before it really kicks into the global market.
That's definitely a lot of factors, and it's probably not all of it either. But should oil prices maintain a steady rise, would this be good news for the global economy as well as the Korean economy in the coming year?
Yeah, and that is certainly the hope, isn't it? The idea, of course, being that if these oil-producing economies do much better than they are now, that lift could spill more liquidity into the global market. Now, for Korea, experts are anticipating a potential boost for the shipping and shipbuilding industries as trade heats up again. Korean builders could also be helped since many of their canceled or delayed construction orders in recent years were from Middle Eastern states hit by low oil prices. And we're already beginning to see some positive signs out of the area, out of Saudi Arabia, in particular with Hyundai Heavy Industries. They've begun discussions to work together to build a shipyard by the year 2021 as part of Riyadh's Vision 2030 diversification plan, which of course we've talked about here before.
Well, this is definitely good news for a much needed boost for the sluggish global economy, right?
Let's keep our fingers crossed. A lot can happen between now and then.
I know. Thank you so much for coming in today.
You bet.
And that wraps it up for today and this week. Thanks so much for watching, and we'll be back next week with more business news that matters to you. Until then, goodbye.